Hello and welcome to ET Legal World. My name is Amol Dete, and I welcome all of you to this wonderful virtual session on the ECM, Equity Capital Market. And we are going to understand the major challenges, themes, and wish list of this particular thing. The theme or the title of this particular panel discussion is The Curious Case of ECM. And why this topic is specifically because we all are working from home and adopted the new normal world. I hope everybody is staying safe and taking best care. While we do take care of ourselves and trying to be more cautious in this particular new normal world, I can see the major challenges that the enterprises, small cap companies, large cap companies, and in fact all the businesses are facing. And the challenge is specifically about how to raise funds, from where to raise funds, which product we should focus on, what are the legal challenges, what are the compliance issues, how the regulators are looking at. All these issues are there. So we at Legal World decided that because of VT Legal World, there's a lot of sessions specifically on and industry oriented issues and trying to give the best perspective to the viewers and our readers. We decided to craft a special session on this, and the curious case of ECM is going to discuss all that I just spoke about. And I'm glad to share with you that I have top speakers with me to enlighten us about the current market trends, specifically about the equity capital market or fundraising or the compliance issues. And I would like to introduce all of them to you. My first speaker is Gesu Kaushal, the Executive Director and Co-Head Equity Corporate Finance Market, Kotak Investment Banking. Gesu is the co-head of corporate finance and has 25 years of experience in the investment banking industry. Gesu, welcome on the show. My next speaker is Manan Lahoti, the partner in Indus Law. Manan has over 18 years of experience as a securities lawyer. Over the years, he has advised on some of the largest and prestigious Indian transactions in the domestic and international capital markets. In addition, Manan's practice include advising on pre-offering corporate restructuring, corporate governance, and other securities law matters. Manan, welcome to the show.
Thank you, Amol.
And my next speaker is Kshitij Kade, Senior Vice President, Group Corporate Finance, Adani Group. Kshitij is responsible for group level corporate finance activities for Adani Group on the transaction and transportation and gas verticals. He has been involved in various merger and acquisitions such as Krishnapatnam Port, strategic partnerships and new initiatives such as airports, financing and capital management activities at Adani. Kshitij, welcome on the show.
Thank you, Amol. It's a pleasure to be here.
And my last and a very important speaker is Vishal Yadvanshi. Vishal is the partner at Indus Law. Vishal carries an extensive experience of well over a decade in representing both underwriters and issuers in lending and multi-capital markets transaction, has led domestic and international offerings of equity and equity-linked securities in a wide variety of industries. Vishal, welcome to the show.
Thank you, Amol. Pleasure to be here.
Great. So thank you so much, my dear speakers, for joining to this particular panel discussion. And thank you so much, dear participants. Before we begin, I will just give a small instructions that by any chance, if you have any thoughts, any comments, any questions, do share it in a chat window. Our speakers, I will take those questions with the speakers and try to get the perspective for your question. To begin with, my opening questions to all the speakers is, and I will start with you, Gesu. How do you review the market right now in terms of funding trends, specifically over the last 2 quarters?
Okay, thank you, Amol, and good evening, everyone. Thank you, ET Legal World and Indus Law, for having me in this session. I actually look forward to hearing all the panelists today also, because I think the insights and learnings from these extraordinary circumstances we are all in should be interesting. On your pointed question about fundraising, what I'd like to say is that we've had a fantastic 2 quarters. I mean, irrespective of the circumstances of, put upon us because of COVID, just 2 headline numbers that I like to give. Last whole financial year, the fund raised in the primary markets was about 150,000 crores. And year to date, which is till August mid, this year we've almost reached that amount. So it's actually been a fantastic year for fundraising. However, let me start by saying that the secondary markets actually really did, see a 30-35% erosion somewhere starting mid-Feb. However, March onwards, we started seeing an uptick. And that's not only for the Indian market indices, but also across the world. So yeah, I mean, secondary markets are looking up and good and buoyant, lots of liquidity. Primary markets have been raising record amount of money. So it's all right as far as these two constituents are concerned.
Okay. Thank you, Gesu, for that comment. Manan, how do you vet that? I mean, being a legal, consultant, do you think that whatever Gesu said is absolutely right? Your opening comment.
Gesu always says the only right thing, so without a doubt. No, jokes apart, Gesu is right. So when the lockdown essentially started in India, kind of end of March, in some cities, some states, kind of middle of March itself, people were slowing down work. So there was a lull for almost about 6 to 8 weeks. The businesses were essentially almost not operating. But starting middle of May and more towards June and definitely July onwards, we've seen a big uptick on the deal doing. Um, it started, of course, with rights issues, and we can discuss a little later on why rights and why not something else. But if July was a month for rights issues, August is the month for big block, QIPs and some large sort of open market sales as well.
Yes, Manan, thanks for that comment. Kshitish, how do you review the last 2 quarters, specifically in terms of funding? What are the trends that you see?
Thanks, Amol, and thanks for having me on this interesting discussion and share perspectives with the panelists. I think I think Yesu's right, and sort of Manan sort of supplemented her as well. If you look at the thematics, right, I think with any major event or disruption like a COVID, you always have the risk of mentality that investors have, and then money starts flowing into sort of cash and liquid funds, and then sort of starts flowing back into capital markets. And that's exactly what's happened, not only in India, but also globally, right? I mean, if you look at some of the data coming out of the US, so, I think interestingly, money market funds, which in the US were $3 trillion at the start of the year, they went up to about $4.5 trillion. And that's sort of flowed back into capital markets. And, markets are back to their old level, volatility levels are low. Investors, sort of are taking a view in terms of investing in sectors and scripts which are they like. From an issuer standpoint, of course, sort of a group that I work for, and in community at large, I think people have been focused on raising money, keeping liquidity, the basics of corporate finance in that sense, and managing the leverage. And I think people have been actively, whether it's public markets, like Gesu mentioned on the ECM side, the secondary markets, or even in the private markets, and we've seen some big announcements of late. They are all sort of tending towards that theory that sort of people are taking liquidity, issuers are taking liquidity, investors are taking risks, and I think valuations are back at the levels that they used to be. In fact, past 10 years, if you look at the history, the valuations are actually today lower than the 10-year average. Of course, we can dispute what the growth, etc., is factored in, but the fact of the matter is there is appetite, and there are issuers looking at this market space, and regulatory interface, of course, is there. So I think all constituents are aligned in terms of this year from a capital market standpoint.
Right, Kshitish, what is your view, Vishal? What are your opening comments considering the changes that happened in last 2 quarters? How did you read it?
Yeah, thanks, Amol. I think we've been in this state of semi-lockdown for so long that it's hard to remember a time that was there before that. And it's easy to forget that last 2 quarters also included 2.5 months of pre-lockdown activity. So between January to end of February, early March was one period of activity, and then during the period when there was lockdown imposed by the government, and the companies were looking at trying to figure out what the future holds for them. And then May first week onwards, you could broadly divide the period into those. There was some narrative that was built around the fact that the economic activity in India was already slowing down before COVID hit with all its fury. and all it has done is to accelerate the pace of slowing down. But as far as equity capital markets is concerned, the story is quite different. Actually, there was a fairly healthy amount of activity in capital markets in the period from January to end of February, early March. If you see, and this was led by different by companies across sectors. It wasn't led by one particular sector, but it was led by BFSI. But you had depth in hospitality, QSR chains, dairy companies, logistics. Everybody was looking to try and do a deal. In fact, if some data from early part of the year, I mean, first week of January is typically anyway a holiday period for the investors. You don't typically see capital markets deals during that period. But the 4 weeks that followed saw as many as 5 QIPs. So there was good amount of investor appetite. There was good amount of activity in capital markets. However, of course, COVID happened, and we all had to reset and reboot what was expected, and it was the new normal. Quite logically speaking, the focus thereafter shifted very, very quickly from what kind of sectors and what kind of companies are looking to do capital raising to how can you do capital. So you see, the activity that has taken place post-May onwards has by and large been focused on routes and products rather than sectors. While there are certain products which have been led by entities in certain sectors, but if you see, for example, the rice issue, which has been the flavor of the season so far, right? First quarter of essentially the quarter of rice issues, and there were issues all across the spectrum of sectors. You had BFSI issuers in entertainment, logistics. There was a fair amount of diversity. So the fundraising in the latter half, in the second quarter of the year or first quarter of the financial year, has by and large been driven by the type of product, of course, helped by the regulatory concessions which are provided by the regulators to help them do that.
Okay, right, Vishal. So, let me, change my gears, and obviously, I'm sure everybody is interested to understand more about what is going to happen now, because we discussed what has happened in last 2 quarters, and going ahead, what would be the strategy. So, Gesu, I will come back to you. And considering the background of public offering, specifically in a lot of issues, for example, Rosary, Yes Bank, I have a question in terms of fundraising specifically. Is there a demand for fundraising from the companies? And we have seen a lot of rally into the rights issues. Going ahead, what will it be? Will it be QIP or will it be a different product?
Okay, so good question, Amol. I think there are 2 things we should keep in mind. One, this is a buyer's market, and therefore it's very important what investors think at this stage. We talked about rights issues, but I must point out to you that we have had very large block sales. We've had them in Airtel, way back in March. We've had Bandhan Bank, we've had Kotak Bank, and of course many others. We've had QIP transactions. We've had Kotak, Axis, HDFC, as well as Yes Bank public offer. So the banks have raised a lot of money, and of course there have been rights issues, and I do think this will continue. Just coming back to the investors' point, look, we have pretty good liquidity. The initial run-up, end March onwards, was led by domestic mutual funds. Please note that the SIP flows have been quite sticky, in excess of 8,000 crores per month, and that's kind of been steady even during these COVID times. In addition to that, end April, early May, a lot of the FPI money started flowing in to India, to emerging markets, for whatever liquidity boosts were given in maybe the US, for example. So yes, I think there has been a lot of liquidity. However, investors are doing what? They are picky and choosy about where they will invest. They're very happy to give money, to companies like banks, etc., who want to recapitalize their balance sheets, irrespective of what the capital adequacy ratios are. They're happy with the large caps or the better governed companies to raise money to deal with growth when it will come back after COVID kind of abates. And we've seen that even in the region. And I think the other trend that we think is probably playing out is that, investors also do see that there will be a lot of disruption at the mid cap and small cap level, and therefore invest in large caps. Large caps will therefore then become even potential acquirers of business. They do expect consolidation may happen in many sectors. So I think the investors are playing it smart. Of course, it's a buyer's market, like I said earlier, but making their bets clearly known.
Okay. Thanks, Gesu. Manan, I will take your views here because Gesu mentioned that it is a buyer's market, and that is a sense that we get the kind of money that many companies raised. I can see even the regulators have relaxed a lot of rules and given a lot of boost to the investments. So, what is your view there? Are the regulatory relaxations? It's across products and across sectors, the relaxation which the SEBI and the regulators have given. Is it enough? What is that you look for, and whether it is really beneficial for the companies, those who are raising money?
Thanks, Amol. So, if you just look back at the trend for the last 6 to 8 weeks, maybe last 2.5 months, it kind of answers the question, right? There is, if you plot the kind of transactions which have happened, we started off May, June, but the real activity levels went up only in July. Started with a bunch of rights offerings, followed by a whole bunch of QIPs which are beginning to happen now in August, some in July. In many ways, rights offering is the first or the last port of call for any issuer. For some issuers, it is the first port of call. They want to go back to existing investors, especially when the market has the prices corrected or has fallen because of artificial reasons like COVID. It's not because of business reasons alone or crisis, which is financial in nature. It's of course a very different situation. So the first port of call for some companies at that time was to do a rights offering, and hence you've seen a bunch of. As the market started stabilizing, investors were getting a little bit more confident about the long-term outlook of stock, especially in certain sectors, certain leaders in those sectors. Then we started seeing QIPs. I'm talking more from a promoter-led companies. In a promoter-less or especially managed companies, you would almost always see QIP as a first port of call, nothing else. We saw that the reason why rights offerings happen first is because promoters at times are again the people who get the opportunity to consolidate, but we also forget they also have a moral obligation to fund the company when nobody else is willing to. Yes. So in tough times, even if you go back to the crisis of 2008 and 9, when funding was not available, promoters were essentially required to come in and fund the company, and they may not have liquid cash, so they may take their own time to sort of to kind of fund themselves in a way they can infuse capital in the company eventually, but they do have that moral obligation to begin with. How can promoters typically come in? They can come in either through a rights offering or through a preferential allotment. Preferential allotment under SEBI regulations has a fairly high floor price. It's not a high floor price, but it's a look back period of floor price is pretty long. So you had to look back 6 months average pricing to see what should be the floor below which the promoter cannot come in a preferential. Now, in a situation like ours, in the situation that happened, which is, things were fine until March, and then suddenly there was a deep sort of fall in the pricing. The six months will give you an average which is nowhere near the current market price. So it becomes very kind of unreasonable, unfair to expect the promoters will buy stock at a price which was a pre-COVID stock price. Right. And hence, even if promoters were willing to put in money, they could not come in through a pref. The initial first few transactions to raise capital were hence through rights. And like I said, when the investors were a little bit more sort of confidence in the market also kind of came back or bounced back almost 30-40%. We started seeing QIPs. But most importantly, very recently, SEBI allowed a slightly different floor price for a pref. So instead of look back of 6 months, the floor can be look back of only 3 months. And in July, 3 months is all post-COVID situation. So in many ways, the floor price today for a pref where promoters, for example, can come in is a lot more realistic, and hence we are seeing a whole host of pref transactions. I think if you look forward from here for a second, then you've seen rights, you've seen QIPs, and you've seen pref. I think in future you will see more of combinations. You could go back many years again to see what happened in 2014 when an issuer would want to do a QIP, but investors would probably ask the promoter to also step in and sort of write a check at the same price level. The Indian regulations don't allow promoters to come in through the QIP route. So the promoter must come in to the pref. But today, because the pref pricing and the QIP pricing to a large extent be at the same level going forward, you would see a lot of combination transactions as well.
Very interesting, Manan. Kshitij, I will bring you here. So Manan not only spoke about the regulations, the relaxations, but also the combination of products that we may see very soon. So one, I would like you to comment on this. How do you see the combination of products? And I would also like you to add some perspective on the valuations, because recently I had an interaction with SoftBank, General Atlantic. Everybody is very, very bullish on the Indian market, and in fact, General Atlantic clearly said that the current market is such that the valuations are kind of cheaper and investors have more opportunities to invest. So what is your outlook on the valuation?
No, sure. I think thanks, Amol. And I just link it back to what Gesu mentioned, right? Which is basically it's a buyer's market. When it is a buyer's market, what the promoters' expectations are obviously different at different points in time. But you do have a gap in terms of how how the valuation expectations are from the promoter standpoint and from the investor standpoint. And given it's a buyer's market, really, I think therefore, if you look at what Manan also mentioned, I think we started off with rights as a primary focus area because that's the easiest base for promoters to go back to. Also put in the money, reinforce confidence in the investors, as well as sort of tap your existing investor base. And if you, I don't know, maybe Gesu, you have some charts there, but I would think that the discounts or the offerings that have gone to the investors in the recent past, especially on pref and QIP and primary capital raising, have been at a significantly higher level than sort of historical levels, right? So that sort of underscores the sort of the buyer's market in that sense. But there have been other sort of products as well that have done well. I mean, I think primary offerings, I would probably stretch my neck out and say, going forward, primary offerings will come into the fore, especially for sectors which have good corporates and sort of sectors of liking of the market. But products like InvITs or REITs, I think REITs have been very successful in the recent past. There have been a large offering as well, which was a primary IPO sort of a issue. And so investors are not averse to products, whether they are QIPs, prefs, or REITs or InvITs or whatever else that you sort of throw at them, as long as the pricing is attractive from their perspective. Now, I think valuation is a very complex topic, so I'll sort of maybe just sort of give a little bit of perspective. But yeah, I think sectors which are in vogue today, like for example, whether it's pharma or staple consumers or FIG for that matter, I think they're trading very cheap historically. They used to trade at 25, 30 times P. Now they're sort of traded off 5-6 turns lower. And investors expect in sort of sectors like this and larger issuers that you would have the growth come back, whether it's 12 months or 18 months or 24 months, depending on the sector.
Right.
But growth remains intact, right? And therefore people pick up value, sort of stocks at attractive valuation. So investors are there. I think that the liquidity ensures that there is a good benchmark in terms of market price, and I think they come in at whether it's a pref or a QIP at a discount to that, so it makes it attractive for them to pick up scripts in a larger chunk at so below market price, right? And with a view that stock will go up 15, 20, 30% over the next 12, 18, 24 months. That makes it attractive for them. So a combination of both. I think product wise, I think investors are like primary issuances. They sort of especially from issuers, and I think pref QIPs allow them to sort of take higher stakes or higher chunks. Let's say rights offering where you're an existing investor and then you sort of proportionately take in your stake. So I think the investor community likes the larger sort of primary offerings like prefs, QIPs, IPOs, and at valuation as well.
Okay, thanks, Kshitij. Vishal, kind of a legal perspective here, or if you could add, I mean, just two different thoughts I have. One is about marketing issues, impact of PN3 and Rule 7A of India rules. If you could talk about that, And second is, we all are talking about, pref issues, right issues. The question is also about differentiated structures and issues and issues around rights issues of convertibles. So any comment would you like to make here on those points?
Sure. Thanks, Amol. I think before we
Uh,
discuss PN3, Regulation 7A, etc., I think we need to focus a little bit on the positive steps that the regulator have taken, and Manan touched upon some of these as part of his comments on the steps that SEBI had taken. I think the response of SEBI to this entire COVID-19 induced uncertainty has been quite remarkable. If you see just the way, the swiftness with which COVID-19 entered into all of our consciousness, it has not, it at least at that point of time, did not give anybody any time to understand, react, or respond in an appropriate manner. Keeping that in mind, what SEBI has been able to provide to the issuers and to all the other intermediaries in the market has been quite remarkable. If you see the chronology of the chain of events is SEBI followed there, right off the bat towards the end of March, when there was that first phase of lockdown, which was announced by the Prime Minister, their initial focus was to try and giving some sort of concessions to entities which are currently listed and for whom there was a number of ongoing regulatory filing requirements, compliances, etc., that were coming up. So that was their first focus. The moment that was out of the way, you see, starting from second week of April onwards, SEBI was constantly, Yesu can attest to this fact, SEBI was constantly in touch with market intermediaries trying to understand what works best for issuers in these circumstances, given that we do not know what the second, third, or fourth quarter of this year is going to bring in. Feedback on this issue. We need to ensure that the fast track rights issue option is available to as many issuers with as little hurdle as possible. And that was the focus of SEBI exemptions that were given. They were provided to issuers who were looking to do a fast track rights issue. And fast track rights issue are the one where the issuer does not have to go through the SEBI review process. So the timelines are much crunched and people do not have to wait for 6 to 8 months to be able to cite the funds which have been raised. That was the initial focus. The moment SEBI saw that enough has been achieved on rights issue, they moved on to another product, which also was a free pricing product. The reason why rights issue was so attractive in April and May when all these discussions were going on was because there are no pricing requirements there, right? So the corrected prices in the secondary market, the issuers could do a deal at those corrected prices. The other product which takes advantage of this free pricing provided by SEBI is FPO. So their immediately next focus was on FPO, and again, not on regular FPO, and FPO is follow-on public offering, which is almost as long and lengthy, both in terms of disclosure and timeline, as long and lengthy as initial public offering in IPO. But there is also to do a fast-tracked FPO, and SEBI's focus and thrust was there. They provided similar, not as many exemptions as were given to fast-track rights issue, but they provided quite a few of those exemptions to a fast-track FPO as well, which is where I think Yesu and Shetil also mentioned about Yes Bank was done following the same process. And then they moved on to secondary market had started seeing some sort of revival, right? From the depths of March 23, which is all etched in our memory when the stock markets hit their rock bottom. From the depths of March 23, by middle of May, the secondary prices had started showing some signs of revival, not only on large caps, but also in mid caps. So the focus of the regulator moved in the month of June and July to QIP and preferential allotments, and which is what Manan was alluding to. So after going through the free pricing products, SEBI has now turned its attention and trying to do what it can to help the issuers raise funds through other routes as well. And all these exemptions are by and large available till end of this year. So they're not, except for some of the rights issue relaxation, most of them are available till December 31st, 2020. So the issuers can continue to use these. The other thing that I wanted to focus on was, in addition to the right product, which we've spent some time discussing, right? From an investor point of view, also what has happened is, they also dictate who does fundraising capital markets and in what form do they do capital markets, right? So the public market investors are typically very keen on understanding predictable business models, right? What this pandemic has done is taken away that element of predictability from most of the sectors. and it is completely thrown it up in the air. So, which is why you see when you were discussing IPOs, the reason why there is a little bit of there was at least a little bit of question mark on the IPOs so far was because the public market investors do not have visibility on the track record of unlisted companies and how they perform. For the existing listed companies, they've seen what they've seen in the past, right? So, which is why what you've seen, all of these blue chip companies taking advantage of the excess liquidity in the market right now, because they've demonstrated years the track record of their growth, and the investors are by and large comfortable that once there is some sort of a rebound, our money will be safe and secure here, right? It is for this reason, but I think as we continue to see, even in case of IPO, as the secondary market prices continue to improve, the secondary market sentiments continue to improve, at least the sector leaders, even in unlisted space, will have good chance of raising funds.
Okay.
I would
very detailed analysis, Vishal, and thanks for that comment. So going ahead, Gesu, specifically, when Jio raised a lot of funds, which initially nobody expected, obviously it has a background of Reliance, which is a legacy company, but now Jio expressed its desire to go overseas, and now many companies also started thinking about overseas. So what is the dynamics and potentials of overseas listing that you see, how beneficial it is for the companies?
So Amol, just before I address that question, I'll just pick up on one of the points Vishal made regarding IPOs.
Sure.
And I think it'll be interesting to note that, look, we did not have a very large pipeline as we got into February and March. There wasn't like a big IPO pipeline which was ready to launch and which we missed because of COVID. I think IPO markets do recover with the lag from the secondary markets. And we're seeing that now. We've had Rosary Biotech, which got subscribed some 70 times. We've got the largest ever FPO of Yes Bank concluded. We have a few deals in the pipeline now. So we would see IPO activity kind of coming back. I think so, especially whatever is already in the pipeline. So having said that, to your question on overseas listings, I think India has not had a great history of overseas listings. We did not, of course, have direct listings earlier. We could only do ADRs or GDRs, but it was a very limited product. So GDR market, I think, pretty much went away when we introduced the QIP product in the Indian markets, because institutional investors could come through the QIP route. ADR market, I think it's been quite a few years since anybody actually did an ADR. A big reason of that could be that a lot of the institutional investors overseas are also in the Indian markets now. So it's not like going there to a US market to get a new set of investors. They already do invest in Indian markets. And there are vehicles, FPI registration processes have become so easy that you could pretty much set up an FPI vehicle pretty easily, provided everything's all right with the entity. And so that, having said that, on the direct listing in the overseas markets, yes, there have been news reports about some companies thinking about it. But my personal view is that this is going to be a very limited product. Very, very few companies would probably consider it, primarily because size of companies in India. I mean, Jio, of course, is a very large company, and we don't have too many of that size. It's also important that companies with Indian businesses actually list at home, and that's where coverage will be good. That's where stock, price discovery will be fair. For a whole lot of Indian large caps will end up being mid caps overseas, especially in the US market, and then there is not as much investor interest as it would be in the home country. So I would be a little not still is not the right word, but a little cautiously optimistic about this product for now.
Okay. Thanks, Gesu. Very Meaningful. Manan, I will also take your views on the overseas listing because again, it's spoken a lot. Many people are talking about it. So on a legal perspective, you could tell me what are the problems that you see of overseas listing and highlight a few of the problems, and also supplementary if you could add because we spoke about the combination of products and we spoke about the valuations also partly. Give us some perspective in your view about the pricing. Is it fair considering the recent right issues, QIPs? What do you think is your view specifically on the pricing? So two thoughts, Manan.
Sure. Quite a loaded one. Thank you. The first question itself has quite a few nuances legally. Let me take you through those. So you can list in Indian company through two routes overseas. One is list through a DR, depository receipt. ADR in the US, rest of the world is called GDR. But essentially the underlying share remains sort of in India. It is not listed overseas, but through a DR program, you're able to list. The second method of listing overseas is listing the equity shares directly on the stock exchange. Seems more technicality, and commercially it's the same thing, but there is a difference, and I'll explain the difference. The second way to slice and dice this entire issue is whether you are a listed company in India or you are unlisted in India. If you're a listed company in India, for all these years you were allowed to list overseas through a DR program, not directly equity shares, but
right,
just through a DR program. And a lot of technology companies, Infosys, all these companies over the years have listed in the US. Unlisted companies until 2005 were actually allowed to list overseas through a DR program. But since 2005 and until essentially now, they have not been allowed to list overseas. That is one change we keep hearing about. The DR program, which allows listed companies to list overseas, will now be expanded to allow unlisted companies to also list overseas. It's a big thing. It's a big change whenever it happens. The bigger change still is listing equity shares directly overseas. Whether you are listed in India or unlisted, the question it still remains the same because it's not something which is allowed today. And for a DR, I would say is a bit easier to expand that program to allow unlisted companies also because a basic framework is there. SEBI has seen it for years. It was initially done under Ministry of Finance Circular 1993. So it's been around for almost 27 years now. So there's a lot of understanding of how it works, what is the role of a custodian, what is the role of a depository. All those things are very, very clear. It's a process which can start and finish very fast because it's already there. However, the entire question which has come up recently is about unlisted companies being allowed a DR program overseas. And like Jesus said, for some unlisted companies, it may not make sense, for a variety of reasons. She explained valuation, whether your stock will get covered properly, whether you will get the best long only accounts or not. In India, you will probably, because you're big enough for India, but you may not be big enough for the US. I think that's the question that's the point that she was alluding to. That will always be the case. So every issue that we are meeting these days is thinking about what is the right market. Is it the US? Is it India? Or is it somewhere else? Is it Singapore? Or is it, if you are a biotech company, Switzerland your market or something like that. So people are looking at all venues for listings going forward through a DR program. Through an equity program, our assessment is it will take longer because number of things have to fall in place. FEMA has to change, tax laws have to change. Just the connectivity of the depositories, the central depositories like NSDL, CDSL in India with their counterparts overseas will also have to be done. So there's a lot of infra changes, not only the law changes that are needed for the product to essentially launch. By and large, what we are seeing is some technology companies feel, especially those with a fairly strong global presence and maybe US presence in particular, would like to consider very seriously listing in the US. And it's not only entirely because of valuation, but also because they feel that they want to increase visibility in the US. They want to have the currency of an acquisition in the US tomorrow, or global acquisition in the sort of for which a listing in the US would help them sort of achieve that. So broadly, this is how we are seeing the market. More and more technology companies are showing interest in this conversation. But like Jesus said, everybody will have to pick their right listing venue for a variety of reasons, and pricing could just be one of them. What is also interesting, I want to mention very quickly is, if you see 5, 6, 7 years ago, maybe, it was actually really tough for a startup, as we call it, to list in India. There were certain SEBI requirements which were tough for a startup to comply with. A very simple one is identification of promoters. Startups have promoters, but they're just founders now. They don't hold a large sort of quantity of stock in the company. They don't have the influence like traditional business families would have, who hold majority of the stock as you go through an IPO process. So, to be able to identify whether you have a promoter or not, if you have a promoter, does your founders have enough shares for what is called promoters contribution? In short, 20% of shares should be held by promoters for 3 years after the IPO. So there are a number of, so this was one bucket of issues which Indian startup founders were not able to grapple with. The second was, what do you do with the IPO money? Typically, startups would like to just call it burning the cash. They are acquiring customers. They're not building plant and machineries. So again, SEBI had traditionally seen IPO money being used for either capex, acquiring a plant, machinery, land, or a building, or repayment of loans. But these guys don't have loans either. So there were a lot of issues because of which 5-6 years back it was very, very compelling that they actually list overseas and not think of listing in India at all. But those things have changed. We, as a regulator today, is very business friendly. They are able to discuss something threadbare. They are able to understand if an issue is only for a particular issue, or in which case, of course, it may not work the same way. But if it does address concerns of a larger sector, then SEBI is willing to have a conversation. And hence, you've seen a number of changes. The regulatory arbitrage, in other words, between US listing, for example, versus Indian listing is actually narrowing down these days.
Very detailed one, Manan. In fact, obviously, I can understand coming from a legal perspective, you will cite anything and everything which comes under those, important aspects. I'm happy that participants will enjoy your views, and I can see many participants have already started posting questions. Before I take that question, Kshitij, one more, specifically on the investment fund, Kshitij, I want you to answer this question.
Sure. I think we lost Amol, isn't it?
Or they should wait and raise funds after 6 months or 12 months in the current scenario.
Sorry, Amol, I lost a part of your question. If you could just kindly repeat.
I will certainly repeat. I can see that it's raining heavily in Mumbai and sometimes the network will fluctuate. So, the Kshitij, the question is specifically, for the benefit of the companies, those who are raising funds and who somehow doesn't know, when to raise funds, how to raise funds, and whether they should raise the funds in one entire pool or whether they should raise half the money now, or half the funds now and half the funds after 6 to 12 months. So what is your guidance here?
I think in my past life as a banker, and sort of Gesu will echo that view. Take the money when it is available in as much size that is available. Tell you that it's as a lawyer that it's always better to be prepared to raise money, have your documents in place, have your 144A regs documents in place. But jokes apart, I think it really depends on issuer to issuer, right, as to what is the requirement of capital that you have, and so when it is required. So so therefore, if there is a need to raise capital, then it is so once the market becomes is available in terms of investor appetite, that's a good time to raise money. But yeah, I think the sooner the better, and the sort of you always take as much as you need, and if you get more, it doesn't need to be a larger amount. It's always important to leave some money on the table for the investors because you are.
Back in team, is there an issue? Kshitij, can you hear? Can you repeat?
Yes, I think Kshitij's video has frozen.
Okay, I will.
Sir, if you're able to hear me.
Yes, so I will do one thing. I will go ahead with Vishal, and whenever we are connected with Kshitij, I will take that question. I know it is a very important question, and I don't know, why the network is not in favor when Kshitij was actually giving a guidance about how to raise funds. So, Vishal, my question to you is, in fact, I will take the participants' question now because this seems really interesting. Which jurisdictions will be open initially for listing? Which foreign stock exchanges will allow listing of Indian companies? What will be the COVID effect on capital market and investments in India? This one question is in two parts, but even if we could just focus specifically on the jurisdictions and the foreign listings, that would be really helpful.
I think, yeah, okay. Happy to do that, Amol. So there's fair bit of uncertainty as far as overseas IPO is concerned on the jurisdiction. There's no regulatory guidance as yet. And I'm consciously choosing to call it overseas IPO as opposed to what you would read colloquially being referred to as direct equity listing. Direct equity listing in legal parlance is something like what Spotify was able to do in the US, where they were able to get their stock listed without doing any public offering as such. So one day they were listed, one day they were unlisted, and the next day they got listed.
Right.
That direct listing is without a public offer. So just referring to it as an overseas IPO. As far as the DR, the depository receipts are concerned, the 2014 scheme, which was introduced by the Ministry of Finance, they had listed down a list of 32 jurisdictions. To be honest, it was a fairly liberalized and very progressive piece of legislation, and it listed down every jurisdiction which was worth its salt. The list ran into 30s, if I remember correctly, 32. However, given that that scheme could not be operationalized without a few kinks which needed to, both under Prevention of Money Laundering Act as well as SEBI regulations. The list has effectively been pruned down to 10 stock exchanges. And for those of us who are interested, the list of 10 stock exchanges do not include China, Hong Kong, or Singapore. Essentially, your two US stock exchanges, NASDAQ and YSC, they do include a London Stock Exchange, but do not include Singapore, do not include China. So that is a list of 10 stock exchanges which SEBI has approved for where ADR, GDR transactions can take place. This is also the same list of 10 jurisdictions where Prevention of Money Laundering Act gives the benefit from compliance from beneficial ownership rules. So my sense and assumption is that as and when the overseas IPO program is implemented and set up, they will effectively follow the same.
So can we restore the audio? Oh, yes, I think we managed to restore the audio and video both. Vishal?
Would you need me to repeat any of what I said?
Yes. No, just last part of it, Vishal.
Quick summary. So, 10 jurisdictions have been approved by SEBI under for area GDR program, which is the same list as what has been approved under PMLA rules now for the benefit of exemption from compliance of beneficial ownership rules. I expect the same 10 jurisdictions to be available for Indian companies to do overseas IPO as and when that program is set up.
Right, Vishal, and Kshitij, welcome back. Good to see you after a tech disruption. We'll be really glad if you could continue with your answers on the fundraising, the guidance that you were trying to give.
Amol, was that for me? Sorry.
Yes, Kshitij.
I'm sorry, I don't know why I'm struggling for bandwidth sitting in Ahmedabad, but apologies for that. No, I think as I was saying, I think the best time to raise money is when it is available. So there's no sort of complicated answer to this. Is when the investors like your story and the script, you ought to raise money, not when you need it, but when investors are available to give it to you. I think that's the mantra that we follow in the old banking hat as well as the new. But yeah, I think that's a short and sweet answer to that.
Okay, quite interesting, Kshitij. Very, in fact, interesting and crisp. And I can say that I'm talking to iBankers and the lawyers. I should not forget that. you know, uh, Gesu, whenever being a business journalist, whenever I met anybody or told them that I'm a business journalist, the first question that I encountered was, okay, which are the stocks I should invest in? That's the first question that I encountered in. Don't worry, I'm not going to ask you, where are you raising the money from or which company you are giving the guidance right now. But kind of on the similar lines, because whenever you meet a iBanker, you just try to get a sense on what next. So if you could give me a guidance on two aspects. One is specifically about uh, you know going ahead. What are the products that you see will click specifically for the investors? In terms of raising funds, that would be really nice. And what trends do you think will make the change?
Okay, so Amol, I think investors are in two categories. There is retail or non-institutional investors, and there's institutional investors. If you're talking about retail investors, I think the great products for them are, of course, rights issues. Most all rights issues are at a reasonable discount to the prevailing market price. So of course, if they hold stock and that company is doing a rights issue, those are great opportunities. Of course, IPOs are wonderful opportunities also, because invariably the expectation is that there is an IPO pop and most stock will list up on trade up on listing. As far as institutional investors is concerned, I think there are two themes that are playing out. One is deleveraging, and I think that's an evergreen theme in the last few years. And the other is, raising confidence capital, the term that's being used for, large cap companies or even banks, where there may not be an immediate need for funding. But if it is available, take it now. To Kshitij's point, just take it when it's available. And good companies are able to raise large sums of confidence capital. So institutional investors will pick and choose based on, of course, the sector, the business potential, as well as the product. And the product, the only two products for institutional investors I would see commonly being used are QIPs and IPOs, and of course block trades. That's
Right.
another one. But block trades is not money going into the company; it's going into the hands of the seller.
Any sectors that you're bullish on, Gesu?
So see, I think pretty much most sectors, other than maybe consumer or discretionary spending sectors, I think they're going to do well. So tech-enabled sectors, we see some, the REIT product, especially for the REIT product for real estate, should kind of do well. Banking, I think NBFC stocks can be, acquired at good prices. So yeah, I don't see infrastructure. We've seen that with Reliance. So
Okay.
I think selectively the leaders, the 3, 4, 5 leaders in all sectors should have no problem at all.
Okay, Manan, what do you think? Where do you see the demand, coming from? You must be dealing with a lot of clients, and you must be having a lot of, inquiries coming for, raising funds. So where do you see the uptake?
I think Gesu's covered the sectors quite well, but there's another angle I'd like to cover. The kind of transactions that we are seeing so far, which is, by and large, rights issues of equity shares, fully paid or partly paid, and just a recent transaction, the QIP by HDFC, where there was NCT plus warrants. Apart from these two sort of exceptions, there is not much innovation essentially in sort of primary market. But the trend belies the effort here. There's a lot of queries we get not only on combination routes but also very specific instruments. For example, can we do QIP of a CCPS, CCDs? So in short, if I may take a step back, converts and warrants is a really big market overseas globally. It is not as big a market in India. And there are multiple reasons for it. The regulations in India still have a lot of restrictions on upfront payment, call put, upfront payment, overall sort of tenure of the instrument, not being beyond 18 months, for example, in case of a warrant and stuff, which makes it less marketable. I mean, if you compare the terms for an FCCB, which is a foreign currency convertible bond, versus a comparable product in India, which would be NCD plus warrants or even CCDs by a QIP format, there are a lot of differences. FCCB is still, or appears to be, a lot more sort of flexible and superior product. I think the Indian regulator will have to look at this and grow the convert and the warrants market in India. And once you get into converts and warrants, there are a number of options. One are convertibles and second is exchangeable bonds. So many years back, RBI came out with essentially a regulation which allowed Indian issuers to issue bonds, and the investor had the option of holding the bond until maturity, or at any point of time change those bonds into shares, not of the issuer, but of a group company of the issuer. So a lot of companies are sitting on, on essentially, in a way, treasury stock, if I may use a word, or otherwise as a part of the treasury function, they're sitting on a large position of stock in some companies which will be related to them in the same group or outside. So a lot of innovation around converts and exchangeable bonds is possible and is to be explored. We've also, of course, discussed the US or of overseas listing of Indian companies, but this is where I do see the market growing in the next, I wouldn't say few months, but at least in the next couple of years. And of course, I agree with Gesu. IPOs can't be kept out for too long. Once you have a more stability, a bit more stability in the sort of secondary market, and listed companies are able to raise funds in the next few months, you will definitely see a good comeback of IPOs.
And
thanks,
sorry,
Manan.
to add to that, if I may, in addition to what you said absolutely correctly, what also presents a fairly interesting dilemma to the issuers when they are thinking about some of these structured options are not just the products as well. So, the choice is not just between QIP of equity shares versus QIP of NCD plus warrants. Even once you start dissecting these products, also there are a number of interesting permutations and combinations that can come through. For example, when an issuer is considering QIP of NCD plus warrants, there are considerations such as conversion time period that comes into picture. Well, SEBI allows the warrants to be converted all the way up to 5 years, but if the warrants are being issued to non-residents, under the exchange control regulations, the warrants have to be converted within 18 months. Similarly, SEBI allows only a part payment of warrants upfront. So it could be as little as what we've seen in the past, 1% to 5%. But if the warrant is being issued to a foreign investor, there is a minimum amount of part payment that needs to come in, which is 25% of that upfront. So it presents these interesting sort of dilemmas and structuring options available to issuers. Even in HDFC, for example, you see the warrant issued to domestic issuers for this reason, right? That there is the maximum amount of flexibility which is available to be exercised on warrants can be exercised, and you can issue them separately.
Thanks for the rejoinder, Vishal. With Manan's comment, Gesu, I guess you have comment here. So quickly make it. We are running out of time, but I will take your comment.
Yeah, sure. No, I just wanted to make one point. And when we talk about IPOs, we must note that in the last 3 years, a large part of that fundraising is actually secondary sale and not primary money that goes into the company. Okay. So because of a lot of private equity investments that India has seen over the last few years, there is a lot of fundraising through IPOs, but that's not necessarily all primary money. I just want to make that point.
Thanks, Gesu. We are running out of time, but just quickly, I will take 1 more minute with Kshitij. And if you could tell us, the roadmap for the fundraising, what do you see now for next 6 months, 12 months?
Yeah, so as I mentioned at the start of the conversation, I think, so we started with more blocks and rights issues, etc. And I think we will very quickly move towards, primary capital raise. And as Gesu outlined, some of the private equity investors that are currently in companies, etc., will look to monetize. So the trend, I think, has been in the past as well, a large amount of focus on block trades and sort of capital raising for issuers through pref and QIPs. People have looked at nuanced products in the past, like InvITs and REITs, but that is for specific subset of, let's say, an infrastructure company or a real estate company, where otherwise they are not able to raise money through a let's say, rights issue or a QIP. So therefore, they will go down the path of, let's say, REIT, as Embassy has done. And I think some of the issuers will also look at overseas listing, as Gesu rightly pointed out earlier. That's not a market for everyone. Only for large players who are sizable, like a Jio, for example, can tap it. Because you tend to look at more home markets. I think MSCI had done some interesting analysis early this year, where 70% of the investors and issuers prefer to sort of look at home market listings, because once your regulatory is a check and your liquidity is a check, then it really doesn't matter sort of where the listings happen. But clearly, I see listings coming back, whether it's 6 months or 12 months from down the line, and in sectors which are, as I said earlier, which are in vogue, as well as with issuers that have a good governance framework, as well as corporate sort of finance platforms in place. But yeah, I think mix of will continue to happen through a secondary and primary routes, primarily in India, I would think. I'm not. I just want to add a rejoinder to what you said. I'm not a very big fan of complicating things, but yes, you're right in a sense. I think exchange control regulations are very important mechanism to deepen the market further, whether it's FCEB or sort of having longer period for conversion, etc. I think those are important elements that would help deepen the market and get more money in.
Oh, right, Ritesh. Let's hope that more money will come to India and we all will get some share out of it. I'm sure the iBankers and the lawyers will get the more share out of it. But thanks, Manan, Kshitij, Vishal, and Gesu for the remarkable insights and joining on ET Legal World. Thank you so much for sharing your, comprehensive thoughts. Thank you so much. And dear participants, thank you so much for talking to ET Legal, sticking into ET Legal World and joining this webinar. Thank you so much.
Thank you.
Thank you.
Thank you very much.